What if the US could save $1.1 trillion just by changing one rule at the Fed? It sounds insane, but this could completely reshape banking, markets, and your money. Let's break it down. A new proposal suggests that the Federal Reserve should stop paying interest to banks on the $3.3 trillion they keep at the Fed. Why? To save the U.S. government an estimated $1.1 trillion over the next decade. Let's unpack this. The Fed acts like a bank for banks, and since 2008, it's paid interest, called IORB, on the Reserve Bank's park with it. Before 2008, banks barely held $60 billion at the Fed. Now, over $3.3 trillion. And the Fed pays roughly $186 billion a year in interest on that amount, mostly to big banks. So what if that stopped? Banks would shift their trillions into treasury bills, short-term government debt. That move would spike demand for treasuries, driving their yields down and helping cut borrowing costs for the government. Short-term, it looks like a win. But here's the catch. This doesn't reduce government debt. It just makes borrowing cheaper, temporarily. It's like giving a shopaholic a credit card with lower interest. They'll just keep spending. Also, the Fed currently loses money because it pays more in interest to banks than it earns from its own bond holdings. Removing IORB would flip that, making the Fed profitable again, which means more cash goes back to the Treasury. But it's not risk-free. Banks lose their safest parking spot and must take slightly more risk, even if it's just moving into T-bills. And without interest on reserves, the Fed loses a key lever to stabilize markets, especially in times of crisis. Big picture, this proposal is a temporary fix, not a cure. It could save billions, but it won't stop government overspending or debt growth. So as investors, we need to adjust. This marks a shift away from the 40-year era of falling rates. More volatility, more uncertainty, and a need for smarter financial strategy.